How to reduce taxes if you make $100,000 a year plus as a W-2 employee. My name is Justin Hodges, and this is Chasing Financial Freedom. So you've made it. You're at six figures now. You're in the golden land, and you notice your tax bill has increased though with your earnings as well. Remember, taxes are your biggest expense typically on your budget, so it is savvy to be tax planning pretty much your entire life, from when you start working to the middle and all the way through retirement. Now, how to reduce this? As a W-2, you actually are becoming pigeonholed here, and there's not a ton you can do. That's the bad news. The good news is, here are a few things you can do to help you yourself reduce those taxes. You're going to max your traditional pre-tax 401k or other employer plan, such as a 403b, TSP, et cetera, et cetera. If you're married, max your spouses as well. There's a lot of money. Currently, it's a little over $20,000 each you can do. So, you couple those things together, and it's fantastic. It's pretty much the number one way to go ahead and reduce your taxes if you are making significant income these days. Second thing you can do is either max out an HSA, which is a health savings account, or an FSA, which is a flex savings account. My preference is going to be the HSA for many reasons. It carries over. It's not a use it or lose it. And you can actually invest that HSA too as well. The goal with that HSA is to max it out. There's no income limit to it either, which is awesome. And then it's like triple tax advantage because you put money in, you deduct it essentially. Then you get that thing invested. It grows tax deferred, and then it comes out tax free if you use it for qualified medical expenses, which are ever expanding, if you will. The list is huge. You can also do some cool stuff like transfer rolled over into an IRA at one time in your life if you don't use it all either. Someone can also inherit it, so it's a better estate planning tool and so on. If you don't have access to that, basically you're not eligible. And then there's the FSA through work. Those are okay. Those are a use it or lose it though. So I'm really not a huge advocate of plugging into that. You cannot do both. You can only do one or the other there. Some of you high earners might then have a deferred comp available to you. I don't see this a ton. This is not that common, really. It's typically for really higher level executives or management, essentially. If you do have a deferred comp available, that is a very, very unique plan that you can shove a lot of money into pre-tax and continue to reduce that income down even more on paper. Another little strategy here too as well is you might want to look at moving to a state that is tax-free on income tax, if allowed, or if you work remotely, or just if it fits your lifestyle essentially. That doesn't really apply to everyone, but I thought I should mention it because there are a lot of states where you can live and work remotely and still live a happy life essentially, and reduce your state income tax by a significant amount, 5 to 15% usually. And that does add up and compound and accrue over your lifetime of earnings. Last thing you can do is itemize your taxes versus standard deduct. So to itemize typically involves owning real estate. So you're itemizing and you're writing off that mortgage interest, state and local tax, property tax, et cetera. It's not a huge thing. It's not a guarantee that it will help you either. A lot of it's based on the tax code and your individual scenario. But that's another way you could potentially reduce it down a little bit. Best thing you can do, though, max those traditional pre-tax 401ks out for yourself and your spouse. That's going to be the quickest, easiest, most efficient way to reduce your taxes if you're a high earner. My name is Justin. This is Chasing Financial Freedom.